What if the dividend ETF you trust most just dropped some of its strongest performers? Well, it did. So let's talk about it. This is SCHD, one of the most popular dividend ETFs out there. It's known for simplicity, low fees, and steady income. But here's the thing. Every year in March, SCHD does a full reset. It adds new stocks, removes others, and reshuffles its top holdings. That's called reconstitution. And in 2025, some major changes happened. Now it's July. The dust has settled. We have new dividend data. We have a fresh lineup of top holdings. And we've got a clearer picture of what SCHD is really becoming. But here's what most people miss. SCHD's strategy quietly dropped some companies that actually outperformed the ones it added. That's going to stir some debate. So in this video, we're breaking it all down. What SCHD holds now, how it's changed, and what that means for your portfolio moving forward. Let's get started. Chapter 1. SCHD Strategy and Selection Process. SCHD isn't random. It follows a strict playbook. First, it starts with the Dow Jones US Broad Market. Then it removes REITs. After that, it applies 3 initial screens. 10 years of uninterrupted dividends, market cap at least $500 million, and average daily trading volume above 2 million shares. Only the top 50% in dividend yield move on. Next, SCHD uses a composite score to rank the survivors. That score blends free cash flow to total debt, return on equity, current dividend yield, 5-year dividend growth rate. Finally, the top 100 stocks make the index, but SCHD caps each holding at 4% and each sector at 25%. In practice, this means you get companies that have paid and grown dividends for a decade. You also get financially healthy businesses, and you avoid the yield traps that can haunt high-yield ETFs. So, SCHD's methodology isn't guesswork. It's a rules-based system that favors consistency and quality. In turn, it delivers the reliable income and steadier returns that investors expect. Chapter 2. Changes from the 2025 Reconstitution. What's in, what's out? Every March, SCHD's index shakes up its roster. In 2025, 20 new stocks joined, and 17 were removed. Let's unpack the biggest moves. Key additions: Merck or MRK, ConocoPhillips or COP, General Mills or GIS, Archer Daniels Midland or ADM. Many of these names have dropped in share price recently, yet they still boast strong dividend growth. In fact, the median 5-year dividend growth of the new additions is 33.1%. Notable removals: Pfizer, PFE, BlackRock, BLK, US Bancorp, USB. These companies performed well last year, but they no longer ranked in the top 100 by SCHD's composite score. The median 5-year dividend growth of removals sits at 20.4%. You'll notice something important here. SCHD doesn't chase the highest yield alone. Instead, it balances yield with financial strength and growth. That's why some stocks with decent payouts still get cut, if they fall behind in cash flow, ROE, or dividend history. Moreover, the annual reconstitution itself fuels dividend growth. By shedding lower yield names and adding higher yield, faster growing ones, SCHD engineers a steady rise in its own payout. In short, what goes out can matter as much as what comes in. And in 2025, those choices reshaped SCHD's income and risk profile in a big way. Chapter 3. Top 10 holdings as of mid-2025. What's dominating now? Let's look at the fund's heaviest hitters. Together, these 10 companies make up about 40% of SCHD's assets. Chevron, CVX, ConocoPhillips, COP, Texas Instruments, TXN, Cisco Systems, CSCO, Merck, MRK, AbbVie, ABBV, Coca-Cola, KO, PepsiCo, PEP, Home Depot, HD, Lockheed Martin, LMT. Notice the sector mix: energy, tech, healthcare, staples, and industrials. No single sector dominates. That helps SCHD weather different market cycles. One odd detail: AVI now trades above 4% of the fund. How? It soared in share price since the last reconstitution. So even with the 4% cap on paper, market moves push it higher in practice. Overall, these top holdings blend reliable dividends with steady growth. They reflect SCHD's core philosophy: quality companies that reward shareholders year after year. And they set the tone for the fund's income and performance in 2025 and beyond. Chapter 4: Dividend Snapshot 2025, Payouts and Growth Analysis. Let's talk dividends, because that's the main reason people buy SCHD. In Q2 2025, SCHD paid out 26 cents per share. That's actually a bit lower than the record Q2 payout in 2024, which was around 27 cents per share. Yes, a slight dip, about 5.3% lower year over year for this quarter. But that's only part of the history. When you zoom out, the full picture looks stronger. Through the first 2 quarters of 2025, SCHD has already grown its total dividend by about 6.4% compared to the same period last year. So even though one quarter was down, the year-to-date trend is still solidly positive. Now let's go a little deeper. Since its inception in 2011, SCHD has averaged 11.5% to 13% annual dividend growth. That is huge for a passive ETF. And when you combine that with a forward yield of around 3.6% to 3.9%, you're getting both income now and rising income over time. This is where the power of compounding kicks in. Reinvested dividends buy more shares. More shares mean more dividends. It's the classic dividend snowball, and SCHD is built to roll it faster each year. So yes, one quarterly drop might raise eyebrows, but the fund's overall growth, history, and strategy still strong. In fact, for long-term investors, it might be one of the most quietly powerful income engines out there. Chapter 5: Sector Allocation Trends and 2025 Rebalancing Moves. Now, let's take a look under the hood. SCHD isn't just about the individual stocks, it's also about sector balance. In June 2025, the fund went through a routine quarterly rebalancing. This wasn't the March reconstitution. No stocks were added or removed. It was simply a shift in weightings to stay within limits. The biggest change? Energy. It dropped from over 20% down to around 19.5%. Now, that might not sound like much, but trimming hot sectors helps keep risk in check. Healthcare got a slight boost. So did industrials. On the flip side, technology exposure, which was already low, was reduced even further. Why does this matter? Because SCHD has strict rules. No stock can go over 4%, and no sector can top 25%. These limits prevent overconcentration and help smooth out volatility. Also worth noting, 9 financials were removed in March, but 5 new ones were added. That shows how SCHD adjusts not just for exposure, but also for quality within each sector. So overall, the 2025 rebalancing tells us this: SCHD stays diversified, disciplined, and true to its core strategy, even as the market shifts. Chapter 6: SCHD versus other dividend ETFs in 2025. Now, how does SCHD stack up against the competition? Let's compare it to 2 big names, VIG and VYM. VIG, from Vanguard, focuses on dividend growth, but its yield, usually around 2%, much lower than SCHD. VYM chases higher yields, sometimes above SCHD, but it doesn't screen as tightly for quality. That can be risky. SCHD sits in the middle. It offers a higher yield than VIG and better screening than VYM. It's this balance of income, quality, and growth that sets it apart. Over the last 5 to 10 years, SCHD has delivered total returns of around 11.5% to 12.2% annually. So it's not just about dividends, it's also holding its own on overall performance. Bottom line, for investors who want both reliable income and growing payouts, SCHD continues to be a very hard ETF to beat in 2025. Chapter 7. Verdict. Is SCHD still a buy in 2025? So after all this, is SCHD still a buy in 2025? In short, yes. But let's break it down. The strategy hasn't changed. It's still rules-based. It's still focused on quality, consistency, and dividend growth. The expense ratio? Still just 0.06%. That's as cheap as it gets. Now, even though we saw a small drop in the Q2 dividend, the year-to-date growth is strong. And the new holdings? They show SCHD is still doubling down on fundamentals, free cash flow, low debt, high yield. You're not getting fast gains here, but you are getting predictable, rising income. That's exactly what long-term investors want, especially those looking to reinvest or retire on dividends. So if you're after steady cash flow, low volatility, and reliable income, SCHD still earns its place in a portfolio. And despite a few critics, it might just be the most boring, but effective ETF out there. So that's the truth about SCHD's top holdings in 2025. What changed, what stayed the same, and what it all means for you. Now it's your turn. Do you agree with the latest reconstitution? Was dropping Pfizer a smart move or a big mistake? Let me know in the comments. And if you found this breakdown helpful, give it a thumbs up. Make sure to subscribe for more deep dive ETF updates without the fluff. Thanks for watching. And as always, invest smart, stay patient, and let those dividends keep rolling in.